All right, I'm Michael Hartzman. Today is Tuesday, March 24th, 2026. And I'm on as always with my partner Dominic Tavella on the Lebenthal Report. How are you, Dom?
Doing well, Mike. Back in New York, so happy to be on this part of the world, at least for tonight, anyway.
Yeah, we're happy to have you. And I got home to the sound and sights of landscapers cleaning up my front lawn and laying down mulch. So, in spite of the fact it's 30s in the 30s today, I guess spring is actually around the corner.
Around the corner, it's a welcome reprieve from what we've been going through, Mike.
You ain't kidding. So let's just jump in real quick to the numbers. We got a lot to talk about tonight. So down the war is, in its fourth week, finished 3 weeks last Friday. And, there's no way to sugarcoat it. The numbers are deteriorating. Year to date through Friday, March 21st, the S&P was down 4.6. The Dow was down 4.8, and the Nasdaq was down 6.73. And Dom, to me, the buzz phrase of the last several weeks is off ramp. When and how are we going to unwind this war where the administration gets a W, oil doesn't hit 125 and 150, and the economy doesn't deteriorate? And I think, and you tell me if you disagree, that some of the weakness in the market is perhaps the market losing faith that this off ramp is in the near future.
Yeah. So let's start with your numbers, Mike. They're accurate. The year-to-date numbers, we hit the low for a year-to-date number, but kind of salt to the wound is that all three of the major indices prior to the war in the Middle East, all the major indices were up, what, 2.5%, right? So if we look at the S&P, that now is down a little bit less than 5 for the year, but it was up about 2.5%. So it's really been about a 7.5% swing off the highs. And you look at something like the Nasdaq down, well, a little less than 7%. This is Friday's numbers, but it was up again, up about 2.5%. So we're getting close to a 10% pullback from the highs. And we know the reasons, and you're bringing it up, Mike. Oil, and then the inflationary effects of higher commodity prices across the globe. So the markets, I think, somewhat orderly, but they've been pulling back on a risk-on trade where things may not go quite as well as the administration had hoped. We're yet to determine that, but the market's justifiable saying, "Hey, this picture doesn't look great, and might get worse before it gets better."
Yeah, look, things are, and I think part of the problem originally was the messaging in the first week or two, or the first few days. We've won, we've decimated them, we've obliterated them, whatever adjective you want to use, but then it's still going on, and oil kept spiking, and now the question is, you ask economists, well, what's the line in the sand? Is it $125 a barrel? Is it $150 a barrel? We were in the city last week with another financial institution, and they seem to believe at 150, the narrative completely changes. Right now, the recession word is on the table, inflation's on the table. A lot of narratives that we're not exploring right now, we're worried about right now. If this thing doesn't get resolved quickly, it could be a crazy summer.
Well, all part of this unknown, and we're supposed to guess at this point and try to figure it out. But, Mike, it's one thing about, okay, we're going to come to some kind of resolution. Let's say it's a positive resolution. But in the interim, there's a whole bunch of energy infrastructure in the Middle East that's getting destroyed, and potentially a great deal of it in Iran. So even if tomorrow morning everybody holds hands and sings Kumbaya, How long does it take to get that infrastructure? We're talking about the plants, the gas generating facilities, the processing plants, the oil, gas facilities. How long is it going to take to rebuild that infrastructure to get production back up to speed? And then how long before you clean up the strait so the ships can come in and out? I mean, this is not something that just gets fixed in a week, Mike. So there's high hopes that we come to some kind of a resolution, ceasefire at least. But then rebuilding the infrastructure is going to take quite a bit of time. And that means energy prices stay elevated for quite a bit of time.
And I agree with you. And our guest John E tonight will be able to add a little bit more insight to that. Look, I understand the motive for the safety of the world, why Israel and America did what they did to eliminate, this dictator and his regime. But politically, and Trump is nothing else. He's been a pretty masterful politician. I still continue to question the timing because he had to be told he was going to wreak havoc on the economy. And if he wasn't told that, he should fire his economic advisors.
Um, Yeah, there's a lot of that, Mike, that we may actually never know the answer to, right? And I hate to say to his credit, he did tell us it was going to take a couple of weeks, a month. They have, for all intents and purposes, decimated Iran's military arms, the Navy, the Air Force, the missiles, right? And perhaps, hopefully, so to a point where they can never rebuild it again, or at least become the threat that they have been in the past. Um, but again, if you destroy it all, there is a time element to rebuilding it. And I think the premise here was they need to get it done prior to when we get close to the November election, right? The midterms are extremely important to both parties. And I think the longer they waited to initiate some kind of action, the closer they would get to the midterm. So I think they needed to do it hard, do it fast, and get it done with as quickly as possible. I don't know that they necessarily are away from their timeline, but I do know that even if it all goes well from here, it's highly unlikely. And this is a question to you, Mike. Do you think energy prices by the November elections are the gas prices? Let's talk about what we feel the most pain. The gas prices will be higher, lower than when, not where they are today, but will they be higher or lower than when he started the war in the Middle East?
They're going to be well. They're not going to be low, right?
They're not going to be lower. And
I
that's
mean,
my point, Mike.
yeah, and it's not going to have a two in front of it. It's going to, in one shape, some shape, way, or form, it's going to have a three in front of it. And when I think all the way back to the first real spike in gas I remember, Dom, clearly was Hurricane Katrina, when in the Gulf of Mexico. I guess we could still call it that. It was called that then. The Gulf of Mexico and those refineries were decimated. Gas didn't come down for a really long time.
And that's exactly my point, Mike. It takes time to rebuild that infrastructure, right? So it is highly, in my opinion, and maybe John can give us some feedback on this one. It's highly unlikely, in my opinion, that you're going to see they should be low. Gas prices should be lower than what they are today. Energy prices should be lower than what they are today. But I bet, Mike, they'll still be higher than before the attack on Iran and the Middle East war. And then what are the political implications during the midterms? And I think we're going to have to take that into account in our
Yeah.
modeling.
And look, and just for a little context, my cheat sheet that I've been using since we started this show from JP Morgan, gasoline a year ago was 306 a gallon nationally. Gasoline on New Year's Eve was 281, and gasoline on March 20th, so less than 3 months, is 372. So almost a 90-cent increase in gas. And for people in low to middle income, Dom, that's like getting a tax hike.
And we God knows, I think we talk about inflation every one of our shows. That's an inflationary effect on the economy. And so this promise of bringing inflation down is probably out the window in the near term. And then as a byproduct of inflation, interest rates today are higher than they were 3 weeks ago, right?
Yep.
Inflation goes higher, interest rates are going to go higher. The idea of the Fed cutting interest rates kind of comes off the table. So it sounds really weird, but A leads to B leads to C. And in this case, higher inflation, higher interest rates, at least for the foreseeable future.
Yeah, and just so you know, and to close the loop, a barrel of oil on New Year's Eve was $57.26, and through March 20th, it was $98 off of a $120 high about a week earlier.
Yeah, and I'll guess I'll put a bow on it, Mike. So will it be lower 3 months from now? I think that's a fair estimate. Will it be back to 50 something dollars a barrel? I think highly unlikely, Mike.
I agree with you. So the landscapers are done, but now Oliver has a say. So the dog is barking in the back.
I think Oliver agrees with me as well. Just letting you know.
Oliver has your vote. Um, so look, I think who else may have your vote is John Ede, who's been a frequent guest, one of our original guests on the podcast. We always appreciate his support. And he's the president and CEO of August Research. And we will be right back after a quick break. I'll try to get Oliver to calm down. And we'll be right back with John Ede from August Research. All right, I'm Michael Hartzman, back on the Lebenthal Report with my partner Dominic Tavella and our guest this evening, John E., President and CEO of Argus Research. How are you, John?
Michael, I'm doing great. Thank you. Thanks for having me on the podcast today.
You're welcome. So, John, you just reminded us that the last few shows we had you on, there was other things to worry about. New data coming out of the administration. Who's going to be the new Fed? So you're right. There's always something to worry about. That's kind of the nature of our business. We've all been managers of money through wars and conflict. So by no means does this one feel different. As a matter of fact, while history doesn't repeat itself, it certainly rhymes. So just kind of here we are. What's your take? What's the take in August Research? You heard what Dom and I were thinking. What do you think?
Well, so Michael, I think we are still in a bull market. Okay. Dom pointed out, or you pointed out that we're down 4% year to date. We're about 7% from the highs. But we're coming off a 2026 that was up, 2025 was up 15%, and 23 and 24 were both up 25%, right? Those were three really strong years and a good liftoff to a bull market that started back in October 2022. And you're right, there were some issues that we thought that could potentially derail the bull market. Questions about the veracity of government data on payrolls, or extra pressure on the Federal Reserve. Does it lose its independence? We moved through those structural problems, and now we have a geopolitical and potentially macro issue here facing us with the war and the high oil prices. The good news is that we're coming into this crisis with an economy that has been humming along, with historically low unemployment, with high levels of household wealth. So generally, consumer balance sheets are in good shape. The AI revolution has spurred a great deal of capital investment into technology and into intellectual property products. That's been supporting GDP. Government spending has been a little bit off and on, but with the two really foundational investments in technology and strong consumer sector, um, assuming the war doesn't carry on into the summer, and like you said, oil prices break $150, I would think this gets wrapped up. We avoid a recession. Oil prices don't come back down to $57 a barrel where they were at the end of last year, but maybe in the $70 range, and we see 60s in 2027, and we get back on track. That's the outlook now. Things could change, but those planks in the bull market that we talked about, the growing economy. Now, interest rates had been coming down before they moved back up in this last month, but certainly corporate profits have been strong too. So you've got several positive factors supporting a longer term bullish outlook for stocks, even if this kind of immediate term is somewhat uncertain.
Hey, John, I remind clients when we get the phone calls that literally almost to the day a year ago, after we had the tariff announcements by President Trump, the markets were down at one point, I think, close to 20%, and
They
yet
were, yes.
we recovered and had a pretty good, I think you would agree, a pretty good year. Are you kind of surprised the markets have been almost somewhat rational about this pullback, kind of organized, or it doesn't seem like there's been panic or craziness in the pullback. It seems it's been a little bit reasonable.
Right. A couple things stick out. One is gold has come back to earth, right? That skyrocketed up in the early days of the war, and now it's down maybe 20% from its highs. Perhaps that's an indication that the biggest concerns over the impact of the war are behind us. Another thing that's been encouraging to see has been strength in the U.S. dollar. The dollar weakened, going back to your tariff point, through most of 2025, and was down 10% or so from all-time highs. It wasn't near cyclical lows or anything, but it wasn't the strong and rising dollar that we'd been accustomed to. And that's when you start to worry, maybe there's something wrong with the financial plumbing, or maybe there's something wrong like with the integrity of the data or the independence of the Fed. But now that there's a crisis, capital is flowing back into U.S. securities. I think they've been performing relatively better than global securities during this latest crisis. And I think that's another signal that the U.S. is in a relatively good position to weather what we're facing right now.
John, if you think back 3 weeks ago when you woke up that Saturday morning and heard that, the bombs were dropping, and then you convened with your team, either that weekend or Monday, did you guys take a let's wait and see approach? Did you do anything proactively with the models? Like, where was you and your team's head at when the conflict first started?
Well, so coming into this year, Michael, and we talked about it, we had been anticipating a more challenging year for stocks than those three really strong years that we had, prior to 2026. And part of that, was kind of just patterns. You don't very often get four great years in a row, for one thing. And then two, in the presidential cycle, the second year is typically the weakest year for market returns of the presidential cycle. So you're just kind of planning for market weakness, anticipating that, okay, if it's going to be a more challenging year, you're probably not going to have the great guns blowing out of the tech sector. That Magnificent Seven probably won't be continuing on that run, and it's going to be other parts of the market, the healthcare, the consumer, the energy, the financial. So we had been highlighting those areas, and then even within those areas, within financial, there's a real, growth part of financial, like the payment processors, like Visa and Mastercard, and then there's the, more boring but safer and securer part of the market, like the banks or the regional banks or the property casualty insurers. So we've been not only focusing more on value-oriented sectors as opposed to like the go-go growth of technology. But then even within those sectors, some of the safer, lower beta parts of financial and healthcare and consumer. And then on energy, energy back in the day was the largest sector of the market, and even 10 years ago, it was 10% of the market, different portfolios. I would say one thing we watched very closely the price of oil, and you charted the decline. Even going back to 2022, when a price of barrel of West Texas crude was $95 on average, that came down last year to 65, and it was on its way to 60 or 55 in 2026. And there are secular reasons for that. It's, less expensive to use alternative sources of fuel for power generation. That's just been worked into the economy over these years. So, and we're still at a supply demand situation where there is more supply available this year. I think it's like 106 million barrels per day, and the demand is 104 million barrels per day. So we still have that overhang of too much supply. And that's what, again, when we move beyond these wild cards, that's going to be pushing oil prices lower. I thought that would have a bigger impact, and we were going to see maybe 80 or $85 oil. I didn't think we were going to see $120 oil. So, that quickly filters into forecasts for inflation, and then that works its way into, the 2-year, 10-year treasury spreads and the outlook for Fed funds and ultimately even mortgage rates. So that's been a little bit worse than we had anticipated, but we don't think it's enough to lead to an outright recession here in the economy in 2026 or into 2027.
Hey, John, I know you guys really follow these growth stocks, the tech growth stocks, and I mean, overall they had a good year last year. But if you actually look at the charts since the end of October of last year, they've kind of fallen off the cliff. And this year has been one of the worst performing sectors. The Mag 7, I think, at one point were down as a group, were down close to 10% for the year. Nothing to do with the war, nothing to do with, I don't think, anything to do with the war and oil prices. What's going on in the tech sector?
I think the valuations got too high there, Dom, for a period of time. you're still seeing very good earnings growth. I was looking at tech sector earnings forecasts for first quarter earnings, which are going to come out starting next month, and the outlook is for 40% growth. But they were maybe priced for even something higher. And then you had these threats about artificial intelligence, particularly in the software area, decimating the competitive advantages of these software companies. And so for if a stock is priced for perfection and there's a new risk out there, you get the kind of haircut that we've seen here.
John, let me ask you this. So Kevin, just to switch gears. So Kevin Walsh has been nominated. He's probably going to be the Federal Reserve Chair eventually. The experts are going to give him the benefit of the doubt that he's going to keep the independence of the Fed intact, which I'm happy to hear, of course. But even with things becoming more expensive and things becoming inflationary, do you still see a world where Kevin Walsh does not lower interest rates at least once this year, if not twice? Really, because of the mandate or the insistence of the president, kind of badgering the Fed chair constantly for lower interest rates?
Uh, this makes me think about what Dom said earlier about that day in April when President Trump pulled away his tariff plan. Right, he looks at the S&P futures every morning when he wakes up, and we got pretty close to that bear market that day, and whoops, now we're rethinking tariffs, and maybe we saw a little bit of that earlier this week when the talks were progressing between us and the Iranian leaders. Yeah, I think the our outlook is for one Federal Reserve rate cut here this year. It's been that since the beginning. That's what the Federal Reserve governors are anticipating. You'd think it would be more, that President Trump would be pushing for more, but this is a pretty stubborn and independent institution. And if we're going to have, if on one hand the president is going to be pushing this conflict for several more weeks or months, and those oil prices get stuck up at that $80 to $90 a barrel level for an extended period of time, every $10 increase in a barrel of oil is like 20 basis points on the inflation rate. So if we were at 55 and we get up to 95, that's four $10 increments. That's 80 basis points, and that's putting inflation up at 3.5%, which is just about where the Fed funds rate is right now. I don't. It's hard to see the Fed, cutting twice if and falling behind the inflation curve in that kind of situation. I think one is still on the table, and one is very likely. I don't see a scenario yet where that doesn't happen, but again, that's going to depend on how long this war goes. And to me, that Trump put is a factor in all of this. Just kind of changing the discussion and changing the dynamic, particularly as the midterm elections approach.
So, John, I think a week or two ago, Mike put me on the spot and we made a little joke about stagflation. But now that seems to be kind of a headline almost on a daily basis. Very slow, low economic growth, higher than expected inflation. What's your outlook on the possibility of?
I'm not buying that stagflation, Dom. A few years ago, we were getting the 250, 300,000 non-farm payrolls created every month. The economy was humming along. Lately, that average number has been more like 40,000 or 50,000, and it's actually swung negative a couple times during that period. But the unemployment rate has stayed low, below 4.5%. And with what's changed at the border, we don't have the influx population growth that we had in the past. We don't need to create that many jobs in order to keep the unemployment rate low. So I'm I think the employment growth is consistent with what our economy needs right here. And just, in the past third or fourth quarters, the GDP was growing at around 3%. It's not going to grow that fast. Our economy is like a 2% long-term grower. And this last quarter, I know, was just revised lower to less than 1%, but it still is averaging out around that 2% level. We're watching the employment economy very closely. If we do see unemployment, move up toward 5%. I think that's a trigger for the Federal Reserve to, start to do something. But before we'd see that, we would need to see unemployment claims jump higher. And those have been consistently low around the 220,000 level for the past year through all of this up and down and all of these changes. I think the economy is okay. I do think inflation is picking up here temporarily because of oil prices, but I'm not really buying the stagflation or the high misery index here. I think we're okay.
So look, I think on that note, let's take a quick break, John, and when we come back, let's talk about the market in general. Like Dom and I have been really, basically just talking about this war for the last 3 weeks, but there's other things going on out there. So when we come back, let's talk about those things. So we'll be right back with John Need, President and CEO of Argus Research. All right, I'm Michael Hartzman, back with my partner Dominic Tavella on the Lebenthal Report, along with our guest this evening, John Eade, President and CEO of Argus Research. So, John, speaking of Argus Research, I think it's important to point out to our clients and listeners that you guys manage about 2 billion with a B of client assets. And of that, you manage about 100 million of our client assets. So thank you for being a great guardian of our clients' investments.
Well, thank you, Michael and Dom, and thank you for your trust. We're grateful for the relationship and the opportunity to work closely with you on behalf of your clients.
So are we. So, and one of the reasons we have that trust, John, is I got to give you and Argus Research a lot of credit. You guys were out in front of banging the drum about AI and artificial intelligence and the opportunities long before a lot of your competitors. As I said you earlier, you were one of our original guests on the show, and we talked about that way back when. So you guys definitely saw something that I think a lot of other houses were not seeing at that time. So you touched a little bit on the Mag 7 earlier, but you still think there's opportunity in AI? And I know we're all baseball fans. If you had to put what inning we're in this thing, what would you say where we are?
Okay, on the baseball question, I'd put us in the third to fourth inning.
Okay.
And Michael, to be honest, I think one of the reasons we've been so bullish on AI for so long is that our director of research, Jim Kelleher, who I think has been on this podcast
Yes,
before,
several times.
is actually also our lead technology analyst and has been covering NVIDIA for 10 years. So he's been watching and listening and understanding and appreciating, all that company, which is now what, 7-8% of the S&P 500 can do and has done. So stroke of luck there, but I listened to Jim. He had good ideas, and he ran with it, and it certainly has spread. So a couple things on that. Um, uh, Nvidia, just released its earnings about a month ago, and then they had their big new product rollout just a couple of weeks ago. And Jim's big takeaway from that new product rollout wasn't necessarily like the newest chips coming out, but the folks in the audience. And it wasn't the big cloud computing companies anymore. It was governments, it was healthcare companies, it was financial services companies, all there to learn about the NVIDIA products and to start integrating them more deeply into their own businesses. So I think we're through the first part where we've got the technology generally in place, and it'll keep getting better and better, and that's going to be some more of the middle earnings. But we're in, I think, the early stages here of seeing what the insurance companies are going to be able to do with AI, to see what the big pharma companies and the biotech companies can do with AI. And in fact, we're doing our own set of webinars and podcasts on AI, and going month by month, going through each industry to talk about who the leaders in the industries are, incorporated in outside of technology, incorporating AI into their businesses. So that's having a couple of impacts on the market, Michael. Um, Particularly with earnings, with corporate earnings. We haven't talked much about corporate earnings here, but that has really been the driver of the stock market returns these past 2 or 3 years. In fact, in the past year and a half, we've had mid-teens earnings growth consistently, quarter after quarter. which is above the historical average and certainly above the growth rate of the larger economy. So what's going on with S&P 500 earnings? To me, they're being transformed by the presence of these big tech companies. You talked about the Magnificent Seven companies, now accounting for 35% of the overall S&P 500 market cap. That means they're also accounting for that much of the earnings pie, okay? And these companies are coming into this earnings pie. NVIDIA's net margins are something like 40, 50%. They're very profitable companies. And the big boys of the past, ExxonMobil might have like a 15 or 20% margin. Walmart's got like a 6 or 7% margin. So you've got this new industry coming in, taking over earnings, growing faster than any other industry, and its profit margins are widening too. So, there's some concern that that this profit growth isn't going to last at these rates, and it won't last at 15% forever, for sure. Um, but this, I do think things are different here with corporate earnings, with the major presence of the highly profitable and fast growing tech sector, here driving the bus.
So John, just and we don't want to we're not making a Nvidia call, but you brought it up. The earnings were spectacular. The margins were spectacular. Revenue beat by a mile. And I think I'm being polite when I say the markets had a big yawn to those numbers. Is it they're just worried that they're not going to be able to keep it up? Is that what's going on?
Well, they've been able to keep it up now for several quarters in a row, right? For several years in a row. And realistically, you can't expect 100% year over year growth, or 50% year over year revenue growth. Um, so that will slow. And Microsoft went through that issue several years ago, where the valuations slowed down and the growth slowed down, and then they pivoted into a new part of the tech sector, and took off again because they had the financial strength to uh, pull that off. So I think there's more left with Nvidia, um, but I do think that the valuations generally for the tech sector were hard to support, no matter how fast the growth you were going to achieve. And that's why we've been looking for growth opportunities related to AI outside of tech, in healthcare, in financial services, in the industrials, and in the consumers. And also, I think we talked about this last time, even the utility sector, providing the power to keep the data centers up and running. That's been a growth area too.
So, John, in the same vein, Wall Street loves its acronyms and its nicknames. And if you're a casual consumer of financial TV, you've heard a lot lately about the SaaS trade, which means software as a service. And you hear the experts, the quote unquote experts, talking about the death of software as a service, which I think Dom and I agree, that was a little overdone as well. So could you kind of lend a little color to that? I mean, yes, AI is a threat to some software manufacturers, but there's not a world today where you're going to see one software company after another closing down their doors, do you?
No, I don't think so. And the software is a product that delivers benefits, efficiencies, connections, but it needs to be installed, right? So just the fact that these software companies have their products installed so deeply, across the entire economy, you know, gives them a great presence right? Because to put in the new AI software means you got to, rip out the software that you have in place. That means you got to like run parallel systems for a while to make sure it works. That means you got to like educate your whole workforce how to use these new products. The switching costs are high, to replace the software, that you've already installed. I do think the competition to software, comes from enhancements, and maybe, a company like, let's say, Salesforce.com or Adobe might have a harder time. Software as a service doesn't mean you buy the software once and never pay again. It means you pay every year to get your service, and every year that you pay, you always pay a little bit more because there's always, a new bell and whistle that they throw in. So now maybe these software companies won't be able to charge as much for these new bells and whistles because there's new competitors out there. But I still have a hard time seeing a lot of companies, just ripping out the software that they've spent so many years and so many dollars to install and have trained their entire workforces to use. The same is true, I think, Michael, with some of the financial data companies, like some of the credit rating agencies are, coming under fire. Um, but I think they're safe in a way because they have proprietary data and, methodologies that they've built over years and tested and have shown, proven that works. It's not like they have commodity data, that can, be easily replaced through our artificial intelligence. So I do think some of these trades have, gone overboard, and there are some values in some of these, great companies that are now down maybe 25 or 30% on this fear of AI trade.
Yeah, John, I think you're spot on with that argument. We all run companies, we all pay for software. The idea that we're just going to rip it out and install something new is just not even something as a business owner, even want to think about. Isn't it more logical that those same companies would incorporate AI into their offerings and just make our lives easier than that I'm just going to fire them all and buy some other product? Isn't that more logical?
Then you're gonna have to train Michael on how to use it.
Oh, me, most important. I got to get a whole bunch of new smart young people to figure out how to turn the computer on. And I can pick on Microsoft in this one because we all use a Microsoft-based system. And there's no way we're going to rip out our operating systems. Isn't it just more logical that Microsoft will incorporate AI into their offering of what they're already giving us?
I do think that's entirely the case. But the threat out there that these systems could be replaced, I think takes away some of the pricing power, when they let you know each year that your rates are going up.
So, John, moving away from AI and technology, what other sectors? I know obviously energy is the easy one. That's the low hanging fruit. But what other sectors do you like? I'm going to ask you two ways. One, what sectors do you like if this conflict takes longer than anticipated to unwind? And what sectors do you like if this kind of ends in a timely fashion and we could all get on with the rest of our lives?
So, okay, if it keeps going on, right, you're gonna like the safety and the defensive sectors. You're gonna like, the energy. You're gonna like the big pharma with the nice high dividend yields. The consumer staples companies, and certainly aerospace and defense too. Although that trade has gotten, a little bit away. Some of the areas that we were, really looking at, for, kind of that next level of, AI growth, we're going to be with the payment processors, the Visas and the Mastercards, with the supply chain was kind of coming back together. So trucking and rail companies, there's a lot of opportunity for efficiencies there through AI. Um, uh, Exchanges, right? Capital raising is one of, I think, the raising and allocating capital is one of the core competencies that our U.S. economy has. So, like the CBOEs and intercontinental exchanges, NASDAQs, those companies like that. Some of the growthier areas in the industrial and financial segments were areas that I think have been hit now, and once the war moves away, are opportunities again. But Michael, outside of sectors, we also look pretty closely at different themes. And one of the themes that we like is dividend growth. And so we do a screen of all the companies we cover, 500, looking for those companies that grow their dividends at least 10% a year for 5 years in a row. And it's a very small subset of all that we cover, maybe 80 or 100 stocks. But the average, not all companies pay dividends, for one thing. Some of them cut dividends because things aren't going well. The average dividend growth in any year is 3 or 4%. So companies that are growing their dividends 10% a year for 5 years in a row, really are operating in a high gear. And so that tells you that these companies are well managed. They're growing their margins, they're growing their top line, but we also think that gives a signal to the market too, that our outlook is pretty clear here. Even if there's a pandemic, even if there's supply chain issues, even if there's high inflation, and now we have a war, these companies that are still raising their dividends 10% a year, I think are telling the market that they're confident in their outlook no matter what's going on out there. And so we include a lot of those stocks in our portfolios too. And they show up in pretty much every single industry. There's usually a handful of managements that think that way.
Tom, we got 2 minutes. You want to give John the
Yeah, I
last
want to
report?
squeeze one in if I can. And you mentioned a lot of financial services companies. I'm looking at XLF, the index for financial services company, and I mean, God, the companies on that list are just seem like just top of the line, fantastic companies. Yet the index is down about 10% year to date. What's going on in the financial services world that these companies would get beat up as bad as they have?
Well, some of that is going to be the banks and the backup in interest rates. Slows the mortgage business for a JP Morgan or a Wells Fargo. Some of these are the data companies like S&P and Moody's, and we talked about the threat of artificial intelligence. We think the threat is minimal because they've got the proprietary data. And then some of it might be the Visa and Mastercard, worried about an economic slowdown if gas goes above $4. That's the price, by the way, that Dollar General, that's a company we follow. They say their business is generally fine until gas goes over $4 a gallon, and then it starts to get tough for them. We're not there yet.
So that's interesting because Dollar General, I guess, their demographic is lower income. So that's the folks who have to make a decision between $4 of gas and a trip to Dollar General, I assume.
Right, exactly.
John, we are unfortunately out of time. It seems like we never have time when you're our guest. And as always, we appreciate everything you and August Research does for us on a daily basis and your time this evening.
And John, one of these days we'll have you on when there's no crisis, but hasn't happened yet. So we have wishful thinking anyway.
Well, Dom and Michael, thank you both for your partnership. Thanks for the opportunity to be on with you today, and enjoy the rest of the evening.
Thank
Thank you,
you, and
John.
appreciate it.
And that's it for us on the Lebenthal Report, and we'll be back next week with an all-new show. Have a good night, everybody.